If you want to legally reduce your taxes, follow these steps. Step number 1. You want to write off mortgage interest. If you itemize, you can deduct the mortgage interest, not the principal, that you pay on a loan secured by your primary residence or second home. To claim this deduction, you must be obligated to pay the debt, and you must actually make these payments, which are then reported to the IRS by your lender. So be very accurate, because the lender will send your data to the IRS, and the IRS will cross-check that data with the data that you are actually showing on your 1040. Very important. For first and second homes purchased before December 15, 2017, interest on home loan acquisition debt up to $1 million is deductible. For homes purchased after December 15, 2017, homeowners are allowed to deduct the interest on only up to $750,000 in acquisition debt for a first and second home. So basically, this 25% reduction in the mortgage interest deduction is scheduled to remain in effect during 2018 all the way through 2025. So 2018 through 2025, a 7-year window. But the reduction does not apply to refinancings of homes purchased before December 15, 2017, as long as the new loan does not exceed the amount of the mortgage being refinanced. So this is again a pivotal distinction here. You can also deduct refinancing mortgage points. When you buy a house, you often get to deduct points paid to your mortgage to obtain your mortgage all at one time. But when you refinance a mortgage, you have to deduct the points all over the life of the new loan. So that's called amortization in accounting. That means, for example, you can deduct 1/30 of the points a year if this is a 30-year mortgage. That's basically $33 a year for each $1,000 of points you paid. Doesn't seem like much, but why throw it away anyway? Also, in the year you pay off the loan, because you sell the house or refinance again, you get to deduct all the points not yet deducted, unless you refinance with the same lender. Also, in terms of homeowner deductions, you can deduct mortgage insurance premiums, mortgage interest, and real estate taxes that you pay during the year for your home. Number 2, you can write off state and local taxes. By the way, welcome back to the show. It's really a pleasure to have you here. We're having a conversation about the top 10 biggest tax write-offs you can legally claim. If you itemize, you may deduct your state and local taxes, including 1, property taxes, and 2, state income or sales taxes, whichever is greater. In the past, no limit applied to this deduction. However, taxpayers may deduct a maximum of $10,000 in state and local taxes each year during the same window I talk about, 2018 through 2025. This $10,000 limit applies to both single and married taxpayers and is not indexed for inflation. Let's talk about state sales taxes. So this write-off makes sense primarily for those of you who live in states that do not impose an income tax. So we're looking at you guys from Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington State, and Wyoming. Here is why this is a factor, an important one at that. You must choose between deducting state and local income taxes or state and local sales taxes. For most citizens of income taxing states, the state and local income tax deduction is usually the better deal. For those of you in an income tax-free state, there are 2 ways to claim the sales tax deduction on your tax return. Option number 1, you can use the IRS tables provided for your state to determine what you can deduct. In addition, if you purchased a vehicle, boat, airplane, home, or did major home renovations, you may be able to add the state sales tax you paid on these big ticket items to the amount shown in the IRS tables, up of course to the limit for your state. That's option number 1. Option number 2, you can keep track of all the sales tax you paid yourself throughout the year, and you can just use that. The best way to see that what you can deduct is to use the IRS sales tax calculator. Okay, and so just keep in mind that your total itemized deductions for all of your state and local taxes is limited to $10,000 per year. 3, Charitable donations. So if you itemize, you can deduct any cash or non-cash contributions you make to a qualified nonprofit organization. And you're supposed to have documentation for any cash contribution, including contributions under $250. For all non-cash property, in other words, property contributions and cash contributions over $250, you must have a receipt or acknowledgement from the nonprofit organization. Please make sure the nonprofit is a qualified one. For example, 501c3 and so forth, and so on and so forth. Number 4, write off medical expenses and HSAs. I just want to quickly remind everybody of today's topic. We're having a convo about the top 10 biggest tax write-offs you can legally claim. Medical expenses and HSAs. If you itemize, you can deduct the amount of your medical and dental expenses that exceed 7.5% of your adjusted gross income. So for example, if your AGI is say $100,000, you can deduct your medical expenses only if and to the extent they exceed $7,500. Let me give you an example. If you have 10 grand in medical expenses, you can deduct only $2,500. Eligible medical expenses include both health insurance premiums and out-of-pocket expenses not covered by insurance for both you and your dependents. If you have a qualified HSA, health savings account, you can deduct your contributions to the account and you don't have to pay any tax on any interest you actually earn from the account. To establish an HSA account, you must have a high deductible health plan that qualifies under the HSA rules. And those rules keep changing all the time, so please make sure that you actually have the latest rules. You can use money in your HSA account to pay almost any kind of health-related expenses. And let's talk about medical expenses in general. So when you think about medical expenses, please keep in mind 7.5% of your AGI, that's the cap, really, okay? And also, trips to your doctor's office or hospital appointments qualify for medical mileage. So for this year, you can deduct nearly about 20 cents a mile for travel you made for medical purposes, okay? And this is pretty good. Also, we want to talk about self-employed healthcare premiums. So if you are self-employed, you can deduct the totality of the health insurance premiums you pay monthly for yourself, your spouse, and your dependents, whether or not you itemize deductions, okay? And if you have kids under 27 at the end of this year, you can actually deduct their premiums even if they're not dependents. However, you cannot claim this deduction if you are eligible to participate in a subsidized health plan from an employer for either yourself, your spouse, dependents, or kids under 27 years of age. Number 5, you want to write off 401k and IRA contributions. If your employer offers a 401k, it pays to maximize your contributions, especially if your employer matches them. I mean, you're not writing off those contributions. You are trying to reduce your taxes by contributing to those accounts. So the maximum contribution is about $21,000 for this year. If you are 50 or older, you can contribute an extra $6,500 per year. For IRAs, so IRAs stands for individual retirement accounts, you can contribute $6,000 this year and deduct that amount from your income. But this deduction is phased out if your income is over certain limits and you and your spouse have a workplace retirement plan. If you are 50 or older, you can contribute an extra $1,000. 6, you can actually use student loan interest to reduce your income, to reduce your taxable income. You can deduct up to $2,500 in student loan interest payments per year for the lifetime of the loan. Income limits do apply. And basically, this is an above-the-line deduction that you can take without itemizing your personal deduction. So basically, when you think about it, all taxpayers who qualify may take it. And let's talk about student loan interest paid by you or someone else. In the past, if parents or someone else paid back a student loan incurred by a student, no one got a tax break. To get a deduction, the law said that you had to be both liable for the debt and actually pay it yourself. But now there is an exception. So you may know that you might be eligible to take a deduction, but even if someone else pays back the loan, the IRS treats this as though they gave you the money, and then you paid the debt yourself. So a student who's not claimed as a dependent can qualify for this deduction, so they can deduct up to $2,500 of student loan interest paid by you or by someone else. One thing I want to say here is that when we are speaking about the IRS treating the whole thing as though somebody gave you the money, there are some tax consequences. So the IRS might actually, the person giving you the money might have to pay gift taxes. We have covered this on another show. We have a video about gift and estate taxes. So if you're interested in the topic, please just let us know in the comment section. We'll send you the link. Seven, education expenses in general. I want to quickly remind everybody of today's topic. We're having a conversation about the top 10 biggest tax write-offs you can legally claim. And the thing here is that you can set up a Coverdell education savings account and contribute up to $2,000 per year with phase-outs for higher income people. These contributions amounts were made permanent in 2013, and the amount you contribute is not deductible, but distributions from the account for payment of tuition are tax-free. You can also set up a state-sponsored college savings plan known as Section 529 plan, which basically allows tax-free withdrawals for qualified college expenses. In addition, up to $10,000 to be withdrawn from a 529 plan each year to pay for elementary, middle, and secondary school tuition, which is a boon, if you think about it, to parents who send their children to private schools. Number 8, property taxes. Property taxes may be deductible if you itemize, but a limit comes into play. Under a massive tax overhaul that was signed into law in 2017, deductible SALT, in other words, state and local income taxes, including property taxes, are capped now at $10,000. Now, the limit is scheduled to last through again to 2025 unless Congress extends it. You have moving expenses. So while most taxpayers lost the ability to deduct moving expenses beginning in 2018, one main group of people who can still claim their moving expenses to the IRS are, guess what? The military. So military personnel, not a problem. If you're an active duty military member who is relocating, you can still deduct these expenses if you don't receive reimbursement from the government for the move. So as long as the move is permanent, and this is a quintessential distinction here, and your relocation was ordered by the military, you don't have to pay any tax on qualified moving expense reimbursement. So start getting those receipts out now, because you can claim the cost of travel and lodging for you and your family, moving household goods and shipping your cars and your beloved pets. Okay, and that's good news for the men and women we thank for bravely serving our country. And number 10, the cost to set up IRAs. So anything you pay to a professional to set up your individual retirement account, anything revolving around the IRA or the 401k, you can actually you can write that off, not a problem. So here you have it. Those are the top 10 biggest tax write-offs you can legally claim. I want to quickly give you a few pro tips here. There are other ways to actually reduce your taxes legally, of course, through tax credits. Okay, and so before I spoke to you about deductions, now we can quickly have a convo about tax credits. So when we speak about tax credits, you have the child and dependent care tax credit. Okay, and the cool thing is that this is it's a credit. In other words, it reduces your tax bill dollar for dollar. This is really good. And one thing I want to say here is that this is something you want to really look into. If you have a child, please, you may qualify as long as you are not above the income limits. You may qualify for this child and dependent care tax credit. And it doesn't really just apply for children only. If you have a dependent, let's say you have an elderly relative or a relative who needs help because of medical problems, you can basically deduct whatever expenses you actually allocated to that relative during the tax year. So child and dependent care tax credit. Number 1. Number 2, you have earned income tax credit. So millions of lower income people take this credit every year However, 25% of taxpayers who are eligible for the EITC fail to claim it, according to the IRS. EITC, Earned Income Tax Credit. And some people miss out on the credit because the rules can be complicated. Others simply are not aware that they can qualify. And remember, the EITC is a refundable tax credit, not a deduction, with maximum amounts for different filing statuses, ranging from $560 to $7,000 for this year. Okay, and this is good. And I want to talk about another credit, lifetime learning credit. Okay, and so this credit allows people to claim a tax credit for taking classes at a community college, university, or other higher education institution. The maximum amount of expenses you can deduct is up to $10,000 for an unlimited number of years. However, the top credit you can receive for tax return is worth $2,000. And this credit allows for a dollar-for-dollar reduction on the amount of taxes owed. The expenses can include tuition, fee payments, and required books or supplies for post-secondary education for yourself, spouse, or dependent child. Now, one thing you need to remember is that this credit is not refundable, which means it can be used to pay any taxes you owe, but you cannot receive any of it as a refund. Let me talk about another credit that you might be interested in. That's the American Opportunity Tax Education Credit. So the American Opportunity Tax Credit offers a tax break for the first 4 years of higher education. And the maximum annual credit is $2,500 per eligible student. And if the amount of taxes you owe is zero because of this credit, the IRS says that 40% of any remaining amounts of the credit, a maximum of $1,000, can be refunded to you. Okay, so this American Opportunity Tax Credit offers a partial refund. So the credit is worth 100% for the first $2,000 of qualified education expenses paid for each eligible student, and 25% of the next $2,000 of qualified education expenses. So basically, this means what? If you, your spouse, or child are in school, make sure to look deeper into education credits in general. Okay, for a student who are in the first 4 years of college, this credit could provide greater tax savings than the lifetime learning credit. And qualifying expenses include tuition, fee payments, and required books or supplies for post-secondary education for yourself, again, spouse, or dependent child. And the amount of your credit is actually determined by your income. And this credit cannot be claimed the same year the lifetime learning credit is claimed. So you got to choose either or. And we also have retirement credit. So the contributions you make to a retirement plan, such as a 401k or traditional or Roth IRA, give you a tax credit of 50%, 20%, or 10%, again, depending on your adjusted gross income that you report on Form 1040. This is why it's so crucial to have the right AGI on your 1040, because there are, again, some income thresholds that there are consequences in terms of income thresholds that you might actually fall into. So very important. And the maximum contribution amount that qualifies for the credit is $2,000, $4,000 if married filing jointly, making the maximum possible credit $1,000, $2,000 if married filing jointly. Now, the IRS has a great chart. You have to go to the website or just let us know. We'll just direct you to the right page. The IRS has a great chart on their website to help calculate your credit. Before I close today's conversation, please, I just want to quickly talk to you about the standard deduction. The whole thing is that we have talked about deductions in general, itemizing. We have talked about credits. Now let's have a conversation. Let's go back to the origin. Standard deduction 101. So the standard deduction is basically an automatic deduction from your taxable income that you can receive without any itemizing. One thing I want to say here, before deciding to claim the standard deduction, it's always a great idea to compare your standard deduction amount with your total itemized deductions. So for this year, the standard deductions are nearly $13,000 for single and married filing separate taxpayers, nearly $20,000 for head of household taxpayers, nearly $26,000 for married taxpayers filing jointly, or qualifying widowers. And let me give you a few tips for writing off your expenses and charitable contributions. So it's all about bookkeeping. It's all about record keeping. It's all about paperwork. Keeping a good record of your income and deductible expenses in a spreadsheet throughout the year can make filing taxes a lot quicker and easier. And nowadays, with the advent of apps, mobile apps, you can actually download free apps on your phone and just track everything throughout the year. So come tax time, you have all the data that you need, all the proof, all the receipt that you need. And right now, there are a lot of apps that allow you to actually save receipts on the cloud electronically. So this is pretty good. Okay, so preparing and organizing everything for your taxes can seem like a daunting task, but a lot of people come across the same common mistakes. So don't forget to always include all sources of income. Make sure you are looking for and including all possible deductions, and understand the difference between a deduction and a credit. Okay, some common mistakes people make include not listing all income, not accounting for all possible deductions, and not taking advantage of contribution to retirement accounts to increase tax deductible contributions. So this is important. So if you're filing taxes with several deductions, start by gathering all the appropriate paperwork, such as Form 1098 for mortgage interest rate deductions. For other deductions which are based on expenses or contributions, keep accurate records. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you quickly about the top 10 biggest tax write-offs you can legally claim. Number 1, mortgage interest. Number 2, state and local taxes. 3, charitable donations. Number 4, medical expenses and HSAs. 5, 401k and IRA contributions. 6, student loan interest. 7, education expenses. 8, property taxes. 9, moving expenses. 10, the cost to set up IRAs and 401ks and other retirement accounts. Thank you so much. I will see you next time. But until then, remember, stay marvelous.